Hello, my name is Doug Greenberg, and I'm the president of Pacific Northwest Advisory. Thank you for taking the time to review the video. I like starting the review videos with a couple of headlines from the last week to 10 days. Congress is divided. The Republicans control the House, and the Democrats control the Senate. Markets generally like a divided government because nothing gets done. UBS came out and spoke about their views regarding a recession in mid 2023. Goldman Sachs commented that they believe that the terminal Fed funds rate will be in the area of 5 and 5 1/4. And certainly by now you've heard of the massive fraud that occurred at FTX Exchange and Alameda Research. I will share that I don't believe that this is an indictment on cryptocurrency or the underlying blockchain technology, but rather just a massive fraud that happened to use cryptocurrency. We recognize that the global economy is on the brink of a global recession. The major economic powers all experienced supply side shocks, which have weakened demand or created demand destruction. The anticipation of these large economies as they increase interest rates that will remove money from their economies will push us into a recession, in my opinion. Moody's put this chart out, and I think it's a great chart to see the components of the increase in inflation. Two of the areas I want to focus on. One is the purple, which is the supply chains. And as I mentioned, supply chains have started working better. Certainly, things on the shelves are not all there, but we've seen shipping costs come down. And anecdotally, last week there was one ship off the coast of Long Beach waiting to unload, where during the summer there were hundreds. Energy is an area in which I disagree with Moody's thought process. I believe that as China eventually emerges from its zero COVID policy, that their demand of oil imports, because they're massive, massive import of oil, will again upset the supply and demand of oil and push energy prices higher. I get many questions from clients about the major components of CPI and PCE and their weightings. So I wanted to include that on this chart of inflation. One note, the Federal Reserve relies on PCE as the measure that they use for determining, interest rate policy. When we look at the various leading, coincident, and lagging economic indicators, and again, another great chart by Moody's, we can see that we're beginning to tip in the leading towards that higher recession risk. When interest rates are changed by the Federal Reserve up or down, it takes roughly 9 months for them to fully affect the underlying economy. The first, of course, are the financial markets. They feel the impact first. And in this case, then housing, and then finally employment. And so the start here, which is the jobless claims, is I am watching it very closely to determine the speed of jobless claims as well as that pace to determine the severity of a recession. Morgan Stanley puts out a business conditions index, and in this chart, a number above 50 is expanding in that category, and a number below is contracting. Three of the data points that I want to point out: price index. This is the price that businesses report consumers are paying for their goods. And so we saw a pretty substantial decline. And so I'm looking to see in further CPI and PCE reports if this is reflected in those numbers. Credit conditions index is in a contracting space as well. And in this case, it's in my opinion for two reasons. One, We do have higher interest rates, and so businesses are less likely to want to go borrow to expand, especially in the face of a slowdown or recession. And also, bank loan managers, which are surveyed, have increased their lending restrictions as they also foresee a slowdown or a recession and don't want to lend into that recession. And then finally, the hiring plans index, and this is a survey of business owners. Do they plan to hire? And we've seen that contracting, and we've seen more headlines of businesses laying workers off or just not hiring as many seasonal workers as they have in the past, or replacing those workers that retire or quit. So when we talk about the Fed rate increases, we've seen a pretty dramatic, a very steep movement of rates this year. The economists across the street, and this is a great chart from Morgan Stanley, the economists across the street have this belief that we will, and I do as well, that we will hit a terminal rate, that Fed funds will stay steady to allow the previous rate hikes to fully affect the economy. And then at some point, the Fed will lower rates to stimulate the economy and put interest rates at a more long-term level. This right here, of course, the variable factors are how high, when will they stop, how long will they go before they decrease, and this will be watched, of course, very closely. A bit on fixed income investing throughout this year. As we've seen the 10-year, which is the blue line, increase pretty dramatically, we see a negatively correlated Vanguard Total Bond Market Index go in the other direction. So as rates go up, the price of bonds or bond funds or bond ETFs go down. In December of 2021, I moved client portfolios that owned the longer duration, longer maturity bonds to short duration, a short maturity, and even added a floating rate ETF. And that's represented by these three lines and these returns. So reducing risk in the portfolio started in December of 2021. Again, from Goldman Sachs, it shows their pace, what they believe the pace of rate hikes to be. But I will point out, this is their current terminal rate. The market believes at the end of 2023 will be at 4.48. So there is definitely a differentiation between here, which will cause some opportunity for bonds in the next 3 to 4 months. You might have heard earlier this summer about yield curve inversion or an inverted yield curve. First of all, the Treasury yield curve is simply a line that plots the interest rate or yield of bonds that have the same credit quality but different maturities. So for instance, you can buy a 1-year, it's going to pay you 4.5%, or a 30-year that's going to pay you roughly just under 4%. This is what's known as an inverted yield curve. And what it tells the market and investors is that that a slowdown is coming, a recession is coming, because the Fed is eventually going to have to lower interest rates on long-term debt. So today, investors can buy a 1-year treasury that's going to pay, let's call it 4.5%. They can own that, get a great return, and then in a year receive all their maturity. And then they're able to make a decision. Do they go to the equity markets or do they stay in the bond markets? These here curves down here from 2021 and 2020 is a more regular curve that shows the economy is going to grow in the future. So when we look at the times in which the yield curve has gone below zero, and that's simply, in this case, the 10-year minus the 2-year, the 10-year minus the 3-month, both of those are inverted currently. And then the third is the 10-year minus the Fed funds rate. Those have all, across the last 6 recessions, portended a recession is coming. It doesn't help us with the severity, but it does let us know that that is coming. So clients ask me, and it's a great question, why do we take risk at the start of a slowdown or a recession? And what I share with them is, in fact, we want to reduce risk as the economy slows. These are representative of the 4 different phases in the business cycle: early, mid, late, and recession. And since we know we're headed towards that recession, because we know interest rates have moved so dramatically, throughout this year, I have reduced risk by changing the allocation between stocks and bonds and cash, reducing the amount in stocks, adding to, as I mentioned, the short-term floating rate, short duration bonds, as well as adding to cash. My thought process and my goal is to preserve as much capital as possible so that I have more capital when the recovery phase begins. There will be an outstanding opportunity for bonds here in the next couple of months as rates hit that terminal peak, and we're able to secure some very good, higher yielding bonds with some longer durations and some longer maturities. We recognize, the investment community recognizes that as we head into a recession, or are in a recession, different sectors perform better than others. And in this case, overweighting consumer staples, utilities, healthcare, and to some extent consumer discretionary would produce better returns in that recession vis-a-vis owning the sectors that did so well in 2020 and 2021: communication services, real estate, info technologies, industrials. Again, wanting to preserve capital while we move through the recession, and looking to increase the probability of positive returns as we move through that recession by changing the sectors in the portfolio. So I have started this process throughout this year. There's more to come in terms of adding to these overweight positions from both bonds and cash. But I want to make sure that the portfolios better match the economic scenario that we're going to be in, and believe that we're going to be in over the next 6 to 12 and potentially 18 months. Moodys, another great slide from them. They, of course, have a list on the left of things that could go wrong, that could increase the severity and probability of a recession. I tend to focus on these items. And this chart, on the bottom axis, it's the severity of a shock, and then on the left axis is the likelihood. So focused on these to make sure that if we have these occur, that they're not going to negatively impact the portfolio to the extent that they could if I wasn't focused on them. There is some good news. I recognize that once the Fed stops raising rates, we will have positive returns, more than likely, in both the S&P and in this case the U.S. Bonds. Only in 1 year did we not see that occur, which was the .com, and it just took a little longer. But even looking out, you can see that we get positive returns as we begin to turn in the economy. Thank you for taking the time to review. And if you have any questions, please let me know. Thanks again.